The Nifty is opening about 130-point low.
The stock is up almost 35% in 2022 already. It's up 12% in the month of August alone. Nifty, it is at the day's high. That one is up 70 points.
Last hour of what's been a very interesting day of trade. Remember, it's expiry week, so the moves at times on both sides can get exaggerated.
Ends virtually at the high point of the day. The final tick was above that 17,600 odd mark. Mid-cap index as well, up close to around 1.4%. Nifty Bank, that was the one. That was the big outperformer.
Hello and welcome to CNBC TV 18. You're watching Markets Today, the show where we track about 6 hours of the day's trading action in 5 headlines. I'm Ekta Batra. Here are the headlines for the day. A late rebound helps Indian equities end in the green after a highly volatile session. Sensex and the Nifty close 0.5% higher. Auto surge while IT falls. Nifty IT index falls close to 2%, with TCS and Infosys also seeing big cuts. This is as major IT companies reduce their variable payouts. JP Morgan downgrades the sector. Global crude oil prices inch higher as supply concerns resurface to overshadow demand worries. Saudi Arabia floats the idea of output cuts by OPEC Plus to support prices. Traders fear a drop in US crude inventories. Gas prices also surge to 14-year highs. Auto stocks were in pole position after strong demand expectations. The index surges 2%. Stocks like M&M and Eicher Motors gain 3%. Sterling and Wilson gains after it wins a 2,200 crore NTPC order. Lupin gains 2%, while Gland Pharma ends in the red after brokerage upgrades. All right, well, let's tell you, here's a lineup of what we have in store for you. It's a packed show today. In Market Opinion, we have Nilesh Shah of Envision Capital. In Corporate Voices, we have Venu Nair, MD and CEO, Shoppers Stop. And we have a lot more perspective lined up for you on the show. But let's get to the first story then. The bulls clawed back in trade as stocks made a dramatic recovery on Dalal Street after an early fall. The Sensex gained over 300 points to go back above the 59,000 mark. And the Nifty gained nearly 100 points, with the mid-caps and bank stocks leading the rally. Anuj Singhal is here with the market action.
Well, the market had a very strong bounce after the morning session, or rather the first hour, which looked extremely weak because of the global cues. But both the Nifty and the Bank Nifty bounced right from the 20-day moving average. And auto stocks, as has been the case, led the sort of rally once again. In fact, in terms of the auto names, you had Eicher Motors, which made a fresh 52-week high. Mahindra and Mahindra is nearly there, and Tata Motors was also quite strong. Some other heavyweights which sort of participated in the move or led the market move from the lows, Reliance, ICICI Bank and State Bank of India. The commodity stocks also did well today, so names like Tata Steel, Hindalco and Coal India were all higher. The only sort of weak point in the market today was IT, large cap IT in particular. Names like TCS, Infosys and HCL Tech, though off the lows, but still a bit of a weakness for IT names. And in the F&O space, we had some big gainers like RBL Bank, IDFC First Bank and NMDC. All in all, the market's been making these kind of large moves in both directions. But what today has done is it's given us a bit of a line in sand around the 20-day moving average.
Okay, all right, Anuj, thanks very much for that. So definitely a comeback. But let's get some market opinion then. Nilesh Shah of Envision Capital said that many of the stocks in the broader markets are in a solid bull market. Added that many tier 2 banks and defense-related companies are looking good. Listen in.
What we're really seeing is that a lot of stocks, a lot of sectors, especially in the broader market, are actually in a very strong bull market, and that's really where the opportunity is for India and investing into India. And tier 2 banks, the auto component space, the capex plays and defense, these are some really very interesting opportunities, and I clearly believe that sectors like these are going to be in a very strong uptrend and in a very strong bull market. Clearly, if global equity markets are going to be under pressure, if the US tech space is going to be under pressure, if indices like the Nasdaq are going to be under pressure, it's quite possible that we would probably see some softening or moderation in the valuations. Maybe it's not time to be in the generic IT services companies and be in the specialized mid-cap tier 2 IT services companies. That's where the opportunity is going to be from a multi-year horizon.
Okay, so that's the word coming in from Nilesh Shah. But let's get in some more opinion. Cameron Brandt, the director of research at EPFR Global, said that the rally in the US market was not supported by good flows, called it a summer rally. He also said that he is seeing an increased interest from investors towards the Indian market.
The rally we saw, certainly from a fund flows perspective, was not heavily supported. It had some of the characteristics of a summer rally where a relatively modest amount of money can move asset prices more than perhaps more heavily traded periods of the year. And I'm certainly sort of seeing the turn downwards we've seen in the past couple of days as sort of part and parcel of that general pattern. India's the economy you're most frequently measured against, which is China, has sort of run into definitely a sticky patch. So we've seen a definite uptick in interest in India with funds based outside of India and with more of a long-term perspective.
Okay, so that's some market opinion, but let's get to the second story this evening now. Indian IT stocks were under pressure with the index seeing cuts of close to 2%. This is after Infosys fell over 2% as the IT major cut its average variable payout to 70% for the first quarter. How will this affect margins for the company? Money Control's Haripriya Suresh joins in with the details on this story.
In what has become an industry trend, Infosys is now the latest company to make changes to its variable payouts for the first quarter of FY23. Infosys has told employees that they will, on average, the employees will receive 70% of their variable payout, but it depending on what their pay grade is and what department they're from. It has attributed this to margin pressures, primarily because of compensation revisions that it has done, as well as talent that it has hired. This, of course, comes soon after both Wipro and TCS have made similar announcements. TCS has deferred the payout for certain grades of employees, whereas Wipro has said that anyone in band C and above will not be receiving the variable payout for this quarter. This, of course, for Infosys, its Q1 operating margins was at 20% and its attrition was at 28.4%. All of them are seeing significant increases in wage costs as well as increased attrition. And what the impact of this move will be on Infosys attrition levels remains to be seen.
Okay, all right, Haripriya, thanks very much for that update. But it's not just Infosys. Other IT companies like Wipro and TCS have also cut their variable pays. So what is the variable pay component and how does employee cost affect revenue performance? Reema Tendulkar is here with the details on this story.
Thanks so much for that. I just want to put in context the news that we're hearing from Wipro and now Infosys about variable pays being cut, and TCS as well. You know, there were reports about how they've deferred the variable pay by 1 month for a few employees. For one, variable pay is based on performance. So it's left at the discretion of the company based on the employee's performance. Also for an IT company, the variable pay is usually a part of the CTC and it's not a significant percentage. Also, that another point that's being made is that if IT companies are bringing down the variable pay, will it hurt the attrition? Will we start seeing attrition levels go up? My sense is that unlikely, because IT companies have given heady payouts to employees over the last 2 years in this whole post-COVID digital boom. Now take a look at TCS. While TCS has not brought down the variable pay, we're just using this as an example. TCS's employee cost as a percentage of its sales has gone up by 300 basis points in a span of about 3 years. That just gives you a sense that companies in the last 2 years have handsomely rewarded their IT employees, and therefore this year, if they bring down their variable pay by a small percentage margin, it's perhaps unlikely that it's going to impact the employee morale. Also, we had Info Edge telling us that how even for this year, the core employees are going to be given a salary hike of 12% versus historical levels of 7 to 8%. So even this year, high wage costs have persisted, and therefore variable pay is a small percentage. It's a lever which IT companies have, and they perhaps are looking to flex it given the margin pressures. A word on the margin pressures, yes, they have come down significantly in Q1. Historical low margins for Infy and Wipro in the quarter gone by. high for HCL Tech and TCS. Margins were at 10 and 14-year lows, and across the board, we had cuts of about 100 to 200 basis points seen in the margin performance of IT companies. So the margin pressures are real, and perhaps IT companies are looking to flex the variable pay lever that they have in order to bring down the costs. But my sense is it's unlikely to hurt the employee morale too much. Back to you.
Okay, all right, Reema, thanks very much for that. But that's not all for the IT space. Brokerages are not upbeat on Indian IT companies. JP Morgan has downgraded its rating on the sector from overweight to neutral as they expect to see margin erosion to persist in the medium term. Nimesh Shah is here with the details.
That's correct. So, the global news flow, the domestic news flow and a JP Morgan downgrade has led to a big underperformance of all the IT stocks in today's trade. Now, the JP Morgan has turned further negative and underweight and bearish on the sector. And today in the morning, they've downgraded all the remaining 4 stocks which they were overweight on to neutral rating. The 4 stocks where they're downgraded are Infosys, Tech Mahindra, Infosys and Persistent, all to neutral from overweight after the recent run-up in the price action. Now, they expect the margin erosion to persist in the medium term and stay meaningfully below the long-term trends. In fact, they see limited incremental margin levers going ahead for all the IT names. And in terms of valuations, the entire IT basket is still trading at least 40% higher than the pre-COVID levels, despite the fact that most of the peak growth is behind for all these companies, and margins are structurally getting eroded. So on back of this, they've done further negative and underweight on the sector, and today they've downgraded all the remaining 4 stocks to neutral from overweight, which is Infosys, Tech Mahindra, Infosys and Persistent.
Okay, all right. Tough times for IT. Thanks, Nimesh, for that. But let's get to the third story that we're tracking today. Despite choppiness, crude oil prices are trading higher as the focus has shifted to supply-side factors. This comes after Saudi Energy said OPEC Plus may consider a cut in oil production to stabilize a volatile market and prop up prices. This has overshadowed concerns that the global demand may slip on the back of a recession in many major economies. Gas prices have also been on the rise, with prices in the US trading at 14-year highs and prices in the UK hitting a lifetime high in March this year. Manisha Gupta is here with the details. Manisha, tell us why these prices are on the rise.
Well, yes, the concerns about the gas prices is keeping that commodity on the higher side. You have the US natural gas prices trading at a 14-year highs, the European gas prices at all-time highs, and the UK gas prices also trading very close to those all-time highs. This is after Moscow says that the Nord Stream 1 pipeline will be shut down for 3 days starting 29th of August, and there would be no gas supply to Europe and Germany. Nord Stream pipeline in any case was supplying 20% of capacity, and that has brought in a lot of uncertainty. Not just that, when you look at the Black Sea, couple of pipelines there also are shut. There are concerns also that are being seen in UK, Norwegian gas pipelines as well. So the supply side suddenly seems to be very volatile and uncertain, and that is keeping the gas prices higher. US, even as it is the largest gas exporter right now, the inventories with them also is 20% lower than the 5-year average. So there is a concern coming in, and come winters, you will be looking at higher demand. From 5th of December, European Union also is cutting off Russian oil and gas imports. So there are, as we head into the later part of this year, there are more and more uncertainties coming in case of gas prices, and markets, we do believe that we are headed higher when it comes to this sector.
Okay, all right, Manisha, thanks very much for that. So definitely gas prices in the US at 14-year highs and only rising further. The energy crisis is worsening amid a surge in these prices. RBC Capital Markets' Helima Croft says Europe's resolve on sanctions is key for oil prices. She added the gas prices in the US are likely to rise.
Well, I mean, Europe is going to be ground zero for this energy crisis. I mean, obviously, they are the main importers of Russian gas. The Russians have made it very, very clear they're going to continue to cut off gas supplies into Europe. We're going to have a 3-day outage on Nord Stream 1 starting on August 29th. But we can expect the Russians just to keep the pain up in order to try to force the Europeans to change their calculations about sanctions, about supporting Ukraine. So, yes, gas prices in the United States will also rise, but Europe is going to be really where the pain is going to exist with this war. Russia's only 3% down below pre-war levels. India's taking Russian oil. Turkey, China. What happens, though, on December 5th? That European embargo kicks in. 2 million barrels of Russian oil isn't going into Europe. If those shipping and insurance sanctions kick in, it will be difficult to move those barrels to Asia. The question is Europe going to be in such a difficult economic situation that they don't go forward with those sanctions? To me, that is going to be the key determinant of where prices are. Europe's resolve to see this through in terms of Russia sanctions.
Okay, all right, time for a break now, but stay tuned. We'll be back in a jiffy with all of the other top stories.